Hi, Shelley, welcome. Graham, welcome to the webinar. Aldo, welcome. Roe, PD, and Paul, welcome. Hi, Linda, Derek. Hi, Carolyn, Dario, welcome. Jess and David. Welcome. We'll be starting shortly. I want to make sure that we start right on time. In order to respect your time, I appreciate you joining. Hi, Ellen. Hi, David. Thanks for joining. Aus, Leila, Nuru, Sherez, thanks for joining. Welcome, Jeff, Miranda, Tom and Lori. Welcome, Judy and Dawn. Oh, we have quite a few coming in now. Hi, Mike. Hi, Karen, Melanie, Melissa, Colin. Hi, Krista, Norbert. Hi, everyone. Thank you for joining. It looks like we have a whole slew of people coming in. So I'm sorry if I did not have a chance to call your name out and welcome you. I do say welcome. As I mentioned previously, we're going to start right on time. I want to be respectful of your time. So we will start right on time for this presentation. Leda, welcome. Bev, welcome. I have about 3 more minutes and then I'm going to get started. Just let the last few people come in. Hi, Francis. Welcome. Hi, Jeff. Jessica, hi. Paul, hi. Thanks for joining. Lori, hi. Hi, Ellen. Hi, Trish. Thanks for joining. David, hi. Mike, hi. Derek, hi. Thank you, everyone, for joining. I appreciate you coming to the webinar, and hopefully you'll be able to take some good information away from this. Just got a couple more minutes and we'll get started. Rajesh, hi. Nadia, hi. Welcome. Leda, hi. Shanti, hi. Sherez, hi. Catherine, hi, welcome. Okay, everyone, it looks like we still have a few more coming in. I'm going to start my video here just to say hi. Thank you for coming. We still have a few more coming in, but I am going to start my presentation for you. They will just kind of slowly come on in. So first of all, thank you. Thank you for joining. I really appreciate it. Okay, so I want to go first through a few housekeeping items. As you can see, there is a chat at the bottom of your screen. Please feel free to put any questions in that chat, and I will answer them for you. I'm going to have a question period at the very end of this presentation, and I will be happy to answer a couple of questions. If I don't answer your question, I will be in touch to answer it for you. So please feel free to ask any questions whatsoever. Also, there will be a Calendly link in the chat, and that is if you would like to book an appointment just to get a second opinion, to review your current plan. If you have any questions you want to discuss with a certified financial planner, that's what I'm here for. So please feel free, book an appointment, and that will go right into my calendar, and we'll be able to set something up so that we can just speak with each other. Okay, first of all, this webinar is on navigating your retirement landscape in the new normal. So I'd like to, first of all, introduce you to my team at Morris & Morris Private Wealth Management. Unfortunately, I did have another presenter with me, Jeff, one of my associates, and he, unfortunately, about an hour ago, his wife got taken by ambulance to the hospital. So I will be doing his portion of the presentation. So bear with me there because I didn't practice his portion. And I hope everything's okay with his wife. He's been touching base with me a little bit, but hopefully everything is going well. My name is Karen Morris. I'm the principal owner of Morris & Morris Private Wealth Management. I have my certified financial planner designation, as well as being a registered retirement consultant. I've been helping pre-retirees and affluent Canadians since 1995. What I want to do for you is I want to help create peace of mind by reducing any of your personal financial concerns. I want to guide you through critical financial decisions and events. I want to deliver to you tax-efficient strategies that seek to improve your financial plan. And also, I will create a synchronized plan that evolves around you. Now, when you consider the concept of a successful retirement plan, it all starts with having a trusted partner. IG Wealth Management has been engaged in providing comprehensive financial plans for the last 91 years. And today we have over 2,000 consultant practices, and we service over 1 million families. Now, planning is the core to our company's culture, and it's the key ingredient of how we help Canadians reach a successful retirement in our industry. The Certified Financial Planning designation is the hallmark of accredited financial planners. IG Wealth Management has the highest number of CFP accredited financial planners in Canada, and we're very proud of that. Now, in our agenda for this evening, we're going to talk about when markets are turbulent, keeping a long-term focus on your financial goals, how important that is. We'll cover current market conditions. We'll talk about how you can stay the course and be confident. We'll talk about strategies to navigate through these turbulent times that we're experiencing. And we'll also talk about the Morris & Morris Private Wealth Management approach. So the first thing, market volatility. The only constant is change. And that is so true. We know that, we've experienced it. I've been doing this since 1995 and invested well before that. There have been many, many times when the markets have gone up and the markets have gone down. So this is a graph that demonstrates the S&P TSX, and it has delivered since 1956 an annualized rate of return of 8.93%. It has proven to be resilient through the worst market conditions. Now, over the same period of time, there have been many instances where the S&P TSX declined by more than 10%. As the chart illustrates, this has happened 24 times since 1959. Yet each time the market recovered and achieved a higher level. Throughout history, equity markets have experienced volatility. Yet despite this, they continue to be resilient. Staying the course is of the utmost importance during the periods of volatility, as it enables investors to fully recover from these periods and achieve their long-term investment goals. Now, what this slide shows you is what I call the 70% advantage. What you're looking at is the calendar year return year by year, ranked between ranges of 0 to 10 positive, 10 to 20 positive, and on the other way, 0 to 10 negative, 10 to 20 negative, and so on. This goes all the way back to 1926. So 75% of the time, as you can see on this chart, you get a positive experience in the stock market. If you go to the far left, you can see in 2008, the point of maximum pessimism, if you will, the death of capitalism, a range of returns of -30 to -40%. Conversely, look at the right side of the chart. In 2009, coming out of the death of capitalism, the range of returns in 2009 of 20 to 30% positive. This is to your advantage. In the stock market over a reasonable period of time, take advantage of this. So for the past 92 years, the stock market has provided a positive rate of return on a calendar year basis 75% of the time. That's pretty good odds. Now, the chart you're looking at now is the calendar year returns on the S&P 500, going all the way back to 1980. There's a lot of data here, so let's just deal with the far left-hand side, for example, 1980. In that calendar year, 1980, the stock market went up 26%. That was a pretty good year. But what that red dot is showing is the intra-year decline of 17%. So just think about what happened here. As the market begins a new year in 1980, obviously it must have started to accelerate to the positive, and it keeps going up for a while, and we're enjoying that. And then it rolls over and starts to go down. And everyone has a different threshold of pain. So it goes down 5%, 6%. And all of a sudden we're reading about Brexit and Grexit or fiscal cliffs, and we become concerned. At some point, it goes down to, let's say, 12%, 13%. We believe that we should extricate ourselves from the market. This is fun with math only, but on the red dot, down 17% in 1980, if you got out of the market on that day, your cost of opportunity was actually 40%. And the way we get that is if you put $1 in at that exact day, you would get a 40% return. And that's how you win. You cannot achieve your long-term goals in the stock market by consistently crystallizing losses every time it goes down. The important thing to note on this chart is those red dots. That shows that every year, every single year, without exception, at some point during that year, there was a negative rate of return. So at some point during every year, there was a time when you were a little bit scared or when you were wondering, should you change your investment tolerance, your investment profile. Now, this is how we're going to help you. What can you do now to protect your nest egg? Have a plan and stick to it. Ensure you have proper diversification. Invest for the long term. Determine your retirement income withdrawal strategy, and that's very important. We'll discuss that further. And more importantly, strategy number 5, take professional financial advice. We have our designations. We've gone through the school. We've worked hard for this. And why not listen to us, or why not get our help as much as you possibly can? Because this is what we do. You don't go to your general practitioner to have heart surgery. You go to a heart surgeon. So it's the same thing. You need to take advantage of our education and our skills, and let us help you. Now, what does peace of mind look like in retirement for you? The primary focus on many in our industry is only of the performance of your portfolio. Sorry, just one sec, I gotta go back. True, inspiring that a portfolio achieves a superior risk-adjusted return is incredibly important, but it's only one component of a comprehensive financial plan. IG Wealth Management offers a sophisticated approach by creating tailored financial plans that meet your short and your long-term goals. Comprehensive planning is about creating certainty around all areas of your financial future. We'll help you manage your cash flow. We'll analyze your situation to maximize your tax planning opportunities, both today and in retirement. We're going to help reduce your concerns that many of you have about your retirement. We're also going to help you plan for the unexpected, health or disability risks, so that they don't derail your plan that you worked so hard for. We're also going to help you create a plan for you to give back in a tax efficient and meaningful way if that's what's important to you. Planning for all major expenses, and lastly, working with your other professional advisors like your lawyers and your accountants to create a plan for your business is also what we will touch base on. Okay, so let's have a look at the planning process that we look at. So the retirement planning process is not a linear process, and one can jump in and start at several points in this process. The process is meant to be an ongoing process and should be reviewed regularly. For this Learn to Plan, I will focus on the step for determining income longevity when looking for a mutual fund solution and swapping, or what we call riffing, or taking money out of your mutual funds as opposed to a lifetime income benefit or annuity option with guaranteed associated with it. There are no guarantees associated with mutual funds, but this does not mean we cannot establish a plan with a substantial stream of income. Now, looking at this chart, Canadians are living much longer than they did even a decade ago. With all the medical help and advancements that are happening, we are living longer. So this means that our retirement years are 30 to 40 years now. You know, when you think back, people were retiring at 65 and they were living for 10 years, maybe 15. So their planning wasn't as extreme as ours needs to be. We need to think that we're going to live 30 to 40 years and make sure our plan shows that. So this chart shows the average lifespan for 60-year-olds today. It is important to note that half of individuals and couples will live beyond these ages. So it is prudent to plan at least into your 90s, if not more. Our financial plans that we build, the minimum is age 90. We're going more 95 now, just to make sure and put everyone at ease. So living longer is a good thing, but it does create some challenges. So retirees are worried about making their money last for a longer retirement. Retirees feel like they're constantly balancing their choices today with their ability to have income later. They're so worried now about overspending that they might end up under delivering their retirement and not enjoying it as much as they could. And that, I come across that all the time with my clients. I can even have 85-year-olds sitting in front of me and have over $500,000, and they're worried about running out of money. But this is a common factor. We don't know how long we're going to live now, and because we're living longer, that's one of the biggest fears, is running out of money, outliving your money. So there's another concern that living longer increases, and that's inflation. We all know the costs have gone up over time. A fast food meal in the 1960s would have cost 50 to 60 cents. That same meal today costs over 10 times as much. This is the effect of inflation. Inflation is a reality, and the longer you live, the bigger the impact. Also, something that is a concern is a market downturn at the beginning of your retirement, because this can have a big effect on your future income. Having to take income from your investment and not from the growth means there's less left behind to create income from in future years. How do you lessen this risk? It's all about diversification. Now, the strategies I'm using here to demonstrate income in retirement by many in our industry is used by many in our industry. And this is often an oversimplification. This chart is an example of that illustration. The investor starts retirement at age 65. They withdraw 5% per year, or $600 a month in this example. And this example shows that they actually run out of money at the age of 89. So this seems pretty logical and realistic example, but ignores the nature of markets and how markets fluctuations could negatively impact your income plans and your goals. Put simply, if we were only to consider averages, it implies that 50% of our clients would not reach their retirement income goals. Let's look at some examples that reinforce this concept a little bit further. So this is a clockwise example of negative and positive years, and this is only a 3-year example. So what we do, this is still a 5% rate of return, just like that other sample that had the money lasting till 89, but instead we did sequence of returns, because we all know in the market, the returns are not the same every year. They go up and they go down. So that will have a huge impact on your portfolio. So in this example, clockwise, we have a 5% first year, negative 15 the second, and in the third year, we have a positive 25%. So one of the challenges in planning for our retirees is we never know what the future returns of the markets will be. We know that markets do suffer setbacks regularly, but it's difficult to know when this will occur. So if we take this example, what it really does show, and it's the exact same, an investor drawing out 5% per year, or $600 a month, and we have the same 5% rate of return. But with this investment variance in their returns, we can see the impact. So they went from their money lasting till age 89 to now lasting till 83. This sequence reduced their total income drawing years by 6 years, and that's huge. This example demonstrates the retirement risk known as sequence of return risk, or the impact of income planning using an average rate of return. We don't do that. We stress test our plans all the time. I even have clients when the markets are going down, when we have a 2008 or first quarter of 2020 COVID, they will call me and they will say, you know, how am I doing? The markets are down, how am I doing? And I will pull up their plan with the new numbers of the amounts that they've gone down, and I will be able to show them that you're still okay. You're going to be fine. So this is very, very important to have sequence of returns put into your plan, not average rate of returns. So now I'm going to take that and go counterclockwise. So again, 5% the first year, but now they have positive 25 the next year, and then negative 15 the third year. Still on average 5%. So what does that look like? Using the same simplified scenario that we referenced previously, on average return of 5%, 5% payout, this investor depletes the retirement pool by the age of 87. This is better than the clockwise sequence, but it's still not that age of 89. So even though the negative year happens later in this example, the impact is slightly less than the previous example, but the sequence of return risk results in this investor running out of money 2 years earlier than the 89-year estimate. Now I have another scenario here to show you. This is from Fidelity Investments, which is a well-known global money manager, and they created this illustration for us. So the performance reflects a diversified portfolio with 50% equity, 35% bonds, and 15% shorter term investments or cash. They portrayed a long-term constant investment average return of 5.9%. So again, they're using that average rate of return, and they did a 2.25% level rate of inflation. So as you can see from this example, the investor withdrawing 5% a year, inflation adjusted, would have enough income well into their retirement. In fact, the example shows that they do not run out of funds until they reach the age of 100. So if you saw this example, you'd be very excited. You go, okay, I'm set, I'm good for this. But in reality, we have a look at this and we stress test this, and this is what happens. So if you see that positive blue line there, the dark blue line, that was that 5.9% average money lasting till the age of 100. All the lines above it, your money's lasting beyond 100, which is great. But what is important is the lines below it. How would you feel if I told you your money will last till you're 100, but I didn't check it against sequence of returns, I didn't stress test it, and you run out of money at what, 78, 89, 85? That is not good planning, and that is not confidence that you can have around your retirement planning. So now I'm just going to show you how much income you take from your investments can have a big impact on how long that income will last. This chart shows the example of the effects of various withdrawal rates in a moderate portfolio since 1970. Experienced a severe market downturn, as we can see in the chart, substantial inflation, and then a really good market run. In this case, the more sustainable withdrawal rate is 4 to 5%. But with the more recent markets, the prudent rule of thumb withdrawal rate is closer to 4%. But remember, your personal number can be very different based on how you invest and how long your retirement will be. If you spend too much, it does not matter how well the market does, you will deplete your assets sooner. Okay, so now I'm going to do a case study with you about maximizing your retirement paycheck. So this is Nicole, she's 59, and Sam is 58. And this is their initial analysis. They went to another advisor and they had an initial analysis. And this is the information they had for me. So they'll retire in January 2022, and that's definite. There's no negotiation, there's no changing that. They really only expect a slight reduction in their living expenses after retirement, if at all. They have a really nice home in Westmont, Montreal, and they also have a beautiful chalet that they want their adult son, Al, to have. So between good savings on their behalf and an inheritance, they have $1.3 million in their various accounts. So you can see they have GICs, TFSAs, RSPs, but they still are not convinced that they have enough set aside to support their lifestyle till they're in their 90s. So they spoke to an advisor, as I had mentioned, and what this advisor had told them was, number one, They should start withdrawing on the RSPs as soon as they retire to spread the tax bite over time and avoid losing half of what's left over to their estate. They plan to do this and hope to keep the marginal tax rate low throughout retirement and avoid any OAS clawbacks. So financially speaking, their son, Al, he's self-sufficient, but doesn't have any real savings or extra income. And he's actually thinking of proposing to someone that Nicole and Sam hardly know. So Nicole and Sam want to transfer the chalet to Al when they retire and pay that outstanding capital gains tax right away. They also are very nice and they plan on continuing to pay the property taxes for the chalet. The GIC that they have in their portfolio that they bought with their inheritance from Nicole's father is intended for these purposes, and they don't want to take any chances with that money. They have high income now, so they currently use their TFSAs for any shortfalls or unexpected expenses to avoid extra tax at high marginal tax rates. They will also use their TFSA to pay for the chalet capital gains to avoid a big tax hit. Now, when we have a look at, we need to look at where you are today and what your expenses are going to be. So first of all, their after-tax expenses will be $111,600 per year is what they're going to need to live off of. If we add the taxes to that, then they actually need gross from their investments approximately $160,000 a year. That is to net the $111,600. Now remember that withdrawals from RSPs will be fully taxable. Now we have a look at what income they will have coming in. They have a $55,000 pension income, $22,000 approximately between the two of them of CPP and OAS income, and they have $6,440 interest income from their GIC. Now this total equates to $83,440 of guaranteed income. And the difference is what they need to reach in order to have the retirement they're looking for. So they need to reach $160,000 gross. So they need an additional $76,560 per year, which they're saying will come from their RSPs and tax-free savings accounts. Now, the other advisor they had spoken to was correct in saying that sometimes it makes sense to spread RSP income out over time, but he didn't explain the many factors that determine whether it's a good strategy or not. When we reviewed Sam and Nicole's financial goals and their current situation, both financially and personally, we presented to them the following ideas. Number one was splitting their pension income. That's a pretty simple idea, but something they hadn't discussed with their other planner. Number two, we were looking at redeeming the RSPs later instead of earlier. Number three, we were looking at purchasing a small annuity to provide guaranteed income. And instead of using a GIC, which would be a very expensive source of guaranteed income, we're going to optimize their TFSA accounts, including investing them in line with their comfort for return variability. Now, the TFSA of Nicole was invested in a 2% investment vehicle. This is a long-term investment. We may be retiring in a year, but we are going to go through retirement for 30 to 40 years. So if this money is earmarked for retirement, then that's a longer term. So we want to adjust some of these investments. And we also continuing to save TFSAs after retirement, even if it means moving the non-registered or some RRSPs to keep maximizing our TFSAs. We also are looking at deferring redemptions from the TFSA accounts. Finally, the biggest step in this planning is we want to defer the transfer of the chalet to Al and the payment of the outstanding capital gains. We explained to Sam and Nicole the risk of giving the chalet to Al now, especially at the start of a new relationship. and also deferring a large sum expense where possible can increase the net estate significantly. So with the guidance from myself and my team, we started by modeling the current plan that the other advisor had given them. What this current plan shows here in this chart is they will actually need over $500,000 in cash. They'll actually have over $500,000 in cash flow shortfalls in their later years. And at that point, they will be unable to even meet their fixed income needs. So we applied even the basic strategy of splitting the pension income, which really is a no-brainer. And we changed that shortfall from $500,000 to $400,000. They still have a shortfall, but it's less. And then we experimented in our planning by switching the order in which the RSPs, TFSAs, and non-registered investments are redeemed. So it turns out that the RSPs should be redeemed last because the deferral of taxation is more important in their situation than the slight reduction in marginal taxation. The non-registered accounts should be used first, followed by the TFSA. There is no real rule of thumb for this, but it depends very much on individual circumstances. This eliminates all their cash shortfalls and adds hundreds of thousands of dollars to their net estate, even though it also increases their lifetime taxes. So I'm going to go through here with all the different. So this is the redemption strategy, changing that. This is purchasing a small annuity to pay those taxes on the chalet every year. And then this scenario is maximizing their TFSAs every year, even if it means taken from their non-registered or their RRSPs. And this scenario shows leaving the capital gain tax till the end, till the estate time. So this scenario that I've done here is based on constant rate of returns. We can also model changes in returns. So what I have here, these graphs show a few things. When we add the annuity, so the initial plan, this is first the initial plan, and the success, when I stress tested this plan against rate of returns, sequence of returns, this plan that the other advisor had created for them actually is only 66% successful. So then we started implementing some of our ideas that we shared with them. So first off, splitting the pension income. That's only a slight change, changes their probability of success to 67% when it's been stress tested. And then we changed the order of the redemption. Instead of doing the RSPs right from the beginning, we start with the non-registered, and then the TFSAs, and then the RRSPs. So that now put them up to 83%. Then we changed, we bought an annuity to pay the taxes on the chalet every year till death. And that increased it to 89%. Then we optimize the TFSA. And again, every year we optimize the TFSA, even if it means taking from our non-registered or our RRSPs. It is more beneficial for this couple to maximize their TFSAs. So that now changed their plan. The original plan is 66%, now to 92%. And these percentages, again, are their success of achieving their retirement income that they require. And this has been stress tested against many, many sequence of returns. And then finally, we deferred that cottage or the chalet to paying the capital gains upon death. So this now makes the plan 95%. And what really is happening here, even though, so they now have been able to spend $522,000 more in their retirement. It also added to their estate $1,049,000 to pass on to Al. Even though they added $124,000 in taxes, that is really a small price to pay for all of what they're getting. Less than 10% of the extra spending and estate provided, these taxes are. So this all worked out great for them. So now I just want to talk to you about what we do. When we sit down with a client or a prospect, we first of all want to explore your current financial situation. So we want to talk to you about your goals. What are your goals? Give us details of your goals. What does retirement look like to you? Are you purchasing a cottage? How often are you buying cars? At the beginning of retirement, are you going to have bigger trips? And then they're going to become smaller as you are going into retirement and getting older. So we want to know your goals and your objectives. Then we have a look at your current financial situation. We have your supplies with all your statements. I look at your tax return. That's very important. Your cash flow, your detailed cash flow on a monthly basis. And the reason we need all this detail is I need to figure out what is the cash flow that's needed at retirement. And from that, I develop a comprehensive financial plan for you. I customize your investment program, I implement a holistic strategy, and I proactively monitor and adjust your plan as needed. Things will come up, situations will change, and we need to make sure that we update your plan on an ongoing basis. As I said, some of my clients, when the markets have a huge downturn, they're just a little worried and want to have a look at their plan, and they can see that that downturn really didn't affect their plan very much at all. Okay, so these are some questions that I have clients ask themselves. When I do a live presentation, I usually ask them to have a piece of paper and answer yes or no to all these questions, but I'm just going to ask a few so you can really think about what you're receiving from your financial advisor. So my advisor asked me questions about life goals and aspirations. Yes or no? I have a clear understanding of what I have in my portfolio and why. Yes or no? My advisor clearly explained the cost of ownership of my investments. Yes or no? My advisor understands my tolerance for losing money because we've talked about it. Yes or no? And my advisor is a certified financial planner. Yes or no? I am confident my savings will last through retirement even with market variability. Yes or no? So these are just a few. There's about 16 questions there. These are just a few of the questions, but think about them. If you're answering no to these questions, then you really need to reach out for a second opinion. There's no cost for a second opinion. Set up an appointment. As I mentioned, my calendar is in the chat box. Set up an appointment. We will chat and I'll answer any questions you have or see if there's ways that I can help you feel more confident, especially in retirement. When we think about planning a trip, if we're planning a big trip, like a 3-week or month-long trip, there's a lot of planning going into that trip. Now, remember, this is when we could have travel, but there's a lot of planning that goes into. Well, you need to know that your retirement is probably the longest trip you're ever going to go on. So you need to plan for it, and you need to ensure that your plan is up to date on an ongoing basis. Okay, so now I'm going to have a look and see if there's any questions that came into the box, into the chat box, and I'll answer a couple of them because I want to, looking at the time there, I don't want to take much longer of your time. So one of the questions here is, I'm retiring in 2 years. Am I correct in not putting in RSP and instead adding to my TFSA? I actually get that question quite often. And there's so many factors that have to be looked at to answer this question. I look at your income for the year. I also look at retirement, what will your income be looking like? Do you have a pension plan that you'll be getting an income from? Plus CPP and OAS. What does that income look like? Is there a chance that there'll be OAS clawback? So therefore, should we be adding to RSPs because it just makes that bucket that much bigger and have chances of OAS clawbacks? if you have a really high income, it might be beneficial to do RRSPs, even though you're retiring in 2 years, just to get a tax reduction from Revenue Canada. I mean, they take your money and they never give it back. I much rather you pay yourself and be able to have it. So that's an answer. If I didn't answer it completely for you, I will reach out to you and give you more detail, or you can reach out to me. As I said, book an appointment, reach out to me, and I'll definitely go in more detail of your current situation. Now, another question we have here, another one I get, what is the best age to start taking out your CPP? That's a great question. There is no rule of thumb. It depends on your situation. I'll have clients that have a great pension plan. So that's a guaranteed income that they have. So therefore, it probably is more beneficial to them to take their CPP out early, because waiting till the age of 65 and having that larger amount will just hurt them down the road, because their pension is such a great pension that they will get OAS clawback. So what I say to them is, you want to start taking it at 60. It is a lower amount, but you've got 5 years of accumulating that CPP payment before you would have taken it at 65, and now it's a lesser amount, so we have more control of trying to avoid OAS clawbacks. So that's one scenario. Another scenario might be, no, we want to withdraw as much as we possibly can on a tax preferred basis from your RSP, so let's hold off the CPP till 65 so we can get money out of your RRSPs before you get taxed on your CPP. So again, every scenario is different, and really you have to sit down and we have to go through everything to know what the right answer is, because there is really no black or white answer on any of these things. Okay, that's it, because I did take a little bit longer than I wanted to. So any other questions, I will reach out and definitely answer your questions. So thank you very, very much for joining us. If you want to email me, my email is karen.morris@igpwm.ca. I also have Associate Jeff Russell, who was supposed to speak with me tonight, and Associate Krista Morris. Please feel free to email us. As I said, mention a question in the chat box or book an appointment, and I will be very happy to help you. Thank you very much, and everyone have a really great evening. Thank you.